Hi everyone, and thanks for joining again. Today I want to talk about some of the new news that's been confirmed with the Bank of Canada and their statistics, and how our CPI has increased 2% in October above the consensus forecast of 1.9%. This means that the Bank of Canada's most closely watched measures of current inflation is our CPI median and CPI trim, which also increased from the average of 2.4% in September to 2.6% in October. Lately, there's been some speculation that the half point that we were expecting December 11th might pan out to be much less. And I'm here to tell you that that might be an overreaction, and here's the reasons why. Even though we're still seeing inflation in our food costs, it seems that our shelter costs have decreased. Our longer-term inflation trends seem mostly encouraging. Mortgage interest costs have decreased, and so has rental costs year over year. What that means is it's alleviating some pressures on spending and puts a little bit more money in your pocket at the end of the month. The Bank of Canada's 2% target, and more importantly, inflation expectations of consumers and businesses have somewhat normalized and stabilized. With alleviating some pressures, the bank's hand is no longer forced, and it can now shift to a change in monetary policy. And that monetary policy should be addressing softening labor market and weaker GDP data. The bank's policy rate currently stands at 3.75%, and in my opinion, it's a little bit restrictive because of the reduced demand that we see at this time. And our inflation data supports that cause, I think. So what do I expect? I expect the policy rate will continue to be a headwind for our economy until it's reduced to a rate that falls somewhere between 2.5 and 3%. What does that mean to you buyers? Well, if you're a conservative buyer who prefers stability on fixed payments, I think the mortgage rates on the fixed side have likely bottomed out for the time being. I think a lot of the good news has already been priced in. That's why it's at a bottom, in my opinion. Another catalyst why I think it's at the bottom is the rates are kind of affected by the elections and what Trump's going to do in the US. In the near term, it looks like things are going to kind of stay at that range. However, it looks quite different for the variable rate mortgages, and expecting another 1% cut in the near future going into 2025. It's all but inevitable. And at this point, I think variable rate mortgages will decrease in lockstep. So I think there's a good chance that the bank will be compelled to cut further as it becomes clear that its policy has been just, like the rates have been just too high for too long. You're probably asking, well, what's the bottom line? The bottom line is this. For the reasons outlined above, I expect fixed and variable rate mortgages to move in opposite directions, at least for the short period that we kind of observe. And I've seen lenders kind of increase their fixed rate mortgages in response, and I expect others to kind of follow in the weeks coming. So you'll be able to see more of a gap in the fixed and variable rate mortgages. For the next round of employment and GDP data, I'll be able to give you a better understanding of what I think might happen. But whether the Bank of Canada cut by a quarter point or half a point in their meeting next December, the simple fact remains that the bank's policy were just too high for too long, and variable rate borrowers can expect reasonably more several cuts ahead. But what do you think? You can leave your comments below, and I'll see you in the next video. Cheers.